Did you notice what just happened in the bond market? At the close of business yesterday, something extraordinary took place that almost no one outside of Wall Street seems to understand. The two-year Treasury yield dropped to levels we haven't seen in a long time, sending shockwaves through the yield curve and reshaping the entire story of where interest rates and the economy are headed. This isn't about some abstract financial theory. This is about the most important signal the market gives us about the future, and it is flashing red in a way that most economists, central bankers, and media commentators have completely misread. For months, we've been told that the Federal Reserve has everything under control, that inflation from tariffs was sticky, that rates needed to stay higher for longer, that the economy was solid and in a good place. But when you look at what the bond market itself is saying, a very different picture emerges. The two-year yield, which represents the front line of expectations for monetary policy, has collapsed back toward levels not seen in almost a year. At yesterday's close, the Treasury Department's own constant maturity data showed the two-year yield at 3.59%. That's the lowest mark since last September. Think about that for a second. We've just watched the market erase nearly 12 months of tightening expectations in the space of a few weeks. The result? The yield curve is sagging heavily in that critical 2 to 3 year range and even out toward the 5-year maturity. What that means is simple but profound. The market is preparing for much lower interest rates ahead, and it's getting ready to move sharply in that direction. This isn't about a one-day blip or a quirky auction result. It's a repricing of the entire future path of U.S. interest rates. And while the headlines still scream about too much debt or the world rejecting Treasuries, the reality is the exact opposite. Demand for Treasuries remains strong. Investors are piling into the short and middle parts of the curve precisely because they see where this is all heading. Toward rate cuts, toward lower yields, and toward an economy that is not as resilient as the Federal Reserve tried to tell us. Now, many will point to Jerome Powell's speech at Jackson Hole and say that's the reason. Yes, Powell did soften his tone, especially around so-called tariff inflation, which he almost completely removed from his threat list. And yes, he admitted for the first time that labor market weakness is real and growing. But the truth is, Powell's words only confirmed what the market had already been screaming for months. Inflation was never the threat the Fed claimed. What we experienced back in 2021 and early 2022 was a one-time phase shift in consumer prices caused by supply chain shocks, lockdowns, and pandemic distortions. That wave has long since passed. What remains now is the damage: lost jobs, falling incomes, and an economy that is straining under the weight of too much debt. And when the Fed finally wakes up to that reality, it always does the same thing. It cuts rates. Not because rate cuts fix anything, but because that's the only tool they have left. Look closely at the two-year yield, and you'll see it's not just drifting lower, it's sending a signal that the Fed will be forced to abandon its higher-for-longer stance much sooner than policymakers want to admit. The last time we saw the curve behave this way, the Fed was either already at zero or heading straight there. Goldman Sachs even admitted in a recent note that the 5-year maturity has rarely been this expensive relative to other maturities except in moments when the Fed was dropping rates to ultra-low levels. Think about what that means. The middle of the curve, the 2, 3, and 5-year range, is historically rich right now. That's not a sign of rejection. That's the market screaming, rates are going down. And yet, you still hear the same tired stories. Commentators claim the world is dumping treasuries, that foreigners no longer want to fund American debt, that ballooning deficits are scaring buyers away. But take a look at the actual auctions. The so-called poor results you may have heard about are nothing of the sort. In fact, just this week, the 5-year auction cleared at the lowest high yield since last September. That's not rejection. That's demand so strong it's driving yields down. The bid-to-cover ratios may be a little lower than before, but that has nothing to do with investors fleeing treasuries. It's simply about returns. When yields are falling, pure return investors bid less aggressively because they know the fat profits have already been made. But overall demand remains robust, and in some cases, it's even accelerating as more investors seek safety in the face of growing economic weakness. The real story here is the steepening of the yield curve. Last year, we saw the 2-year versus 10-year spread begin to uninvert, a process that to many in the financial press looked like the world rejecting U.S. debt. But that interpretation was backwards. What really happened was bull steepening. Every single time the Fed starts cutting rates, the curve steepens in exactly this way. Long-term yields may back up temporarily, but the short end collapses as markets price in the coming cycle of cuts. That's why what we're seeing today fits perfectly with historical precedent. It isn't unusual, it isn't mysterious, and it certainly isn't a global boycott of Treasuries. It's the market doing what it always does when recessionary forces build and the Fed is forced to change course. Remember, the Federal Reserve doesn't actually control interest rates. Economists like Alan Greenspan may have once tried to convince Congress that they did, but the reality has always been otherwise. In the mid-2000s, Greenspan himself admitted he faced a conundrum when long-term yields refused to rise despite his rate hikes. The same thing happened in reverse last year. Long-term yields rose even as the Fed was cutting. These aren't conundrums. They are the natural functioning of a bond market that anticipates reality long before central bankers are willing to acknowledge it. The Fed can nudge the overnight rate, but the curve itself is shaped by growth expectations, inflation expectations, and above all, the demand for safety and liquidity. Right now, that demand is immense. Look at the labor market data. For months, we've been warned about shortages and wage inflation, yet the beverage curve is telling a different story. Job openings are falling, participation is slipping, households are maxed out on debt, credit card balances have crossed into record territory, and delinquency rates are rising. The so-called solid economy is cracking, and investors know it. That's why the front end of the curve is collapsing. That's why the two-year yield is breaking down toward levels we haven't seen in almost a year. And that's why the 5-year is trading at historically rich valuations. The market is front-running the Fed's next moves, and those moves can only go in one direction: down. What's most astonishing is how consistently wrong the mainstream narrative has been. We were told inflation would stay hot. It didn't. We were told rates would stay higher for longer. They couldn't. We were told the world would stop buying Treasuries. Instead, demand remains overwhelming. And we were told the Fed was in control of interest rates when, in reality, it's the bond market that leads and the Fed that follows. Every single one of these assumptions has collapsed under the weight of data, yet economists and central bankers keep repeating them. Meanwhile, the market has already moved on, already priced the cuts, already adjusted for a future that looks far more like the low-rate 2010s than the inflationary 1970s. So, what happens next? The path forward is clear. Rates are going lower, not just a little bit, but potentially all the way back toward zero. The curve is steepening in preparation for that journey. The middle maturities are rich because investors know this isn't about temporary relief. This is about a structural shift back to stagnation, back to the kind of sluggish growth and suppressed yields that defined the last decade. The 2020s are shaping up to look eerily similar to the 2010s, if we're lucky. If we're not, the economic damage could be even deeper, and the rate environment even more extreme. This isn't about Powell's words at Jackson Hole. This isn't about partisan politics or foreign buyers fleeing. This is about the fundamental mechanics of markets and money. When the economy weakens, when jobs are lost, when incomes shrink, investors seek safety. They buy Treasuries. Yields fall, the curve steepens, the Fed eventually follows. It has always been this way, and it's happening again right now in front of our eyes. The only question is how long it takes policymakers to admit what the market already knows. And this is where I want to leave you with a thought. What you're watching unfold isn't just another financial cycle. It's the slow unraveling of assumptions that have guided policy and public belief for years. The idea that inflation would stay elevated forever, gone. The belief that the Fed was in control, shattered. The claim that global investors would abandon the Treasury market, disproven by their actions every single day. In their place is the cold, hard reality. Rates are headed down, and the bond market has been right all along. If this analysis gave you a clearer picture of what's really happening beneath the headlines, if it made you stop and think about how the future might look different than what we've been told, then I invite you to stay with us. We are entering a period where the markets will speak louder than central bankers, where every shift in the yield curve tells us more than 1,000 speeches. And it's during times like these that having the right perspective matters most. That's why I share these deep dives, not to scare, not to hype, but to reveal the truth that often hides in plain sight. By subscribing, you're not just following another channel, You're joining a community of people who refuse to settle for surface-level answers, who want to cut through the noise and understand how the economy, money, and markets really work. Together, we can track these changes as they unfold, question the assumptions we're fed, and prepare for the realities ahead. So, if you haven't already, take a moment right now and subscribe. Not because numbers matter, but because knowledge matters. And the more people who understand what's happening, the stronger our community becomes. This story is far from over. The yield curve will keep reshaping, the Fed will keep reacting, and the markets will keep sending signals most will ignore. But you won't. You'll be here, following along with us, and together, we'll stay ahead of the noise and closer to the truth.